America in 1929 was booming. The stock market was rising fast, businesses were expanding, and people believed prosperity would last forever. During the Roaring '20s, factories produced cars, radios, and appliances at record speed. Credit was easy, and banks were lending money to almost anyone who asked. Many Americans began buying stocks with borrowed money. This practice, known as buying on margin, allowed people to invest more than they could actually afford. At first, it seemed like a smart decision. Stock prices kept climbing, and investors felt unstoppable. Confidence turned into overconfidence. On October 24th, 1929, panic entered the market. Investors rushed to sell their shares as prices began falling sharply. This day became known as Black Thursday. 5 days later, on October 29th, the market completely collapsed. Black Tuesday saw millions of shares dumped in a single day, wiping out billions of dollars in wealth. The crash did not only hurt investors, banks had also invested heavily in the stock market. When prices collapsed, banks suffered enormous losses. Fears spread quickly. People rushed to withdraw their savings, creating massive bank runs. Thousands of banks failed within months. With banks closing, businesses could not borrow money. Companies shut down, factories stopped producing, and unemployment began rising rapidly. By 1933, nearly 25% of Americans were unemployed. Millions of families struggled to survive without stable income. Red lines stretched for blocks as people waited for food assistance. Homeless communities, called Hoovervilles, appeared across the country. The crisis spread beyond the United States. International trade collapsed, and economies around the world entered a deep depression. In 1933, Franklin D. Roosevelt became president. He promised action and introduced a series of programs known as the New Deal. The government created public jobs, built infrastructure, and introduced strict banking regulations to restore confidence. One of the most important reforms was the creation of the FDIC, which ensured bank deposits and protected people's savings. Recovery was slow, but confidence gradually returned. The economy began stabilizing toward the late 1930s. Full recovery did not happen until World War II, when war production created millions of new jobs and boosted industrial growth. The Great Depression permanently changed the American financial system. It reshaped government policy, banking laws, and economic regulation. It also left a powerful lesson for future generations. Markets can rise quickly, but they can also collapse without warning. Even today, economists study 1929 to understand how financial bubbles form and how economic crises can be prevented. The Great Depression remains one of the most important chapters in American financial history. A story of collapse, hardship, and eventual recovery.